This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the podcast, I have Eric Wong. Eric is with a family office based out of Hong Kong. His family, entrepreneurs going back many, many decades. And I think their story is quite interesting and how they have moved towards this family office investing structure, working with other traders, other types of strategies, all in an effort to try and make money during the down times, to try and pursue those uncorrelated returns. An interesting conversation. I hope you enjoy. Hey, Eric, how are you?
Hi, Michael. How are you doing?
Not too bad, not too bad. So where am I reaching you today? Hong Kong?
Yes, I got back night before yesterday and settled in more or less.
Where were you coming from?
I was coming from the States. I had a 3-week trip through the States, visiting all over the place, including even Mexico City.
Wow. So is home base for you Hong Kong typically?
Yeah, home base is Hong Kong.
Gotcha. Well, I think you've got an interesting story, and I think for me, I think it's going to be fun to probe for some insights. And one thing I should outline: I had the good fortune to travel around mainland China and Hong Kong, giving speeches to perhaps many people that you know earlier this spring. And so I was in Hong Kong and Beijing and Guangzhou and Shenzhen and Shanghai. A lot of the larger Chinese mutual funds, but just a really wide, interesting path of people to talk to. And so I think it's going to be interesting today to talk to you about your perspectives, because reading up, you definitely make the case, and I think wisely so, that the rest of the world still has a long way to go to understand how China really operates.
Yeah, I'd say even the Chinese have a long way to go to understand how China operates. They might have a bit of an advantage, but still, even then, it's a mystery wrapped within a riddle, wrapped within a sphinx.
I will say this: the thing that I noticed and I saw some comments that you said this for the people that jet in and maybe go to a meeting and then hop right back out. I don't think they have any clue how useless that is.
Yeah, I would agree with you completely. But well, they can, I've seen some people succeed in spite of themselves in China, and they just didn't realize how big of an advantage they might have been bringing, and they never push. If they might get lucky. People always get lucky, but they never exploit their advantage to the fullest and capture the opportunity, because it's usually very fleeting, whatever it is in China. Nothing like putting the Chinese on an arb. They'll slam it right shut very quickly. So the guys who come in and they actually make it work, and because of their luck, something changes after a while. Market changes, people get wiser. And then all of a sudden they didn't even know what hit them when they fall out of their bed and they realize their business was gone.
The thing that I noticed that makes sense when we're little kids is it's just the whole idea of being friends. And I saw just the idea of showing up and going to dinners and talking about everything and exchanging views on a friendship level probably seemed like the most important thing. And I was guessing, as I was in the middle of so many different experiences, that's probably one of the number one things Westerners get wrong.
Yeah, I mean, I'd agree partly with that, in that certainly, decisions are made by those who show up. Then showing up is certainly a very good first step, and repeatedly showing up is just part of the sales process. But then some things are kind of without a more in-depth understanding and of the mechanics and what drives these people to make decisions the way they may do. And oftentimes it isn't market dynamics that is driving it. It's sort of the political So sometimes people get used in the sense of they were there, possibly as a white face or whatever, to push forward certain ends that were not related to the opportunity at hand and really just a political gambit. So I mean that happens as well. So it's sort of it just takes time. I mean, you make lots of mistakes and then you just keep soldiering on, and eventually you sort of start getting a little bit of a feeling of how things work.
I don't know how a Westerner can do it without speaking the language. To me, that seems number one.
I think I would agree with that. At the same time, I'd say now the level of English is picking up, and depending on what type of business you're in, you could possibly get by, with translators or something like that. But it just takes maybe just longer time then. But I'd say the advantage is that a Westerner would go in at least knowing that they don't know much, whereas sometimes some people from Hong Kong, including myself, used to go in and think that we actually knew what was going on because we kind of looked like the person we were talking to, but the mentality is just so completely different. We just didn't know at all that we were dealing with a very completely different thought process.
Well, when I made the comment about speaking the language, it wasn't necessarily because there's not, especially in the worlds that you and I are talking about, plenty of English being spoken. There is. It was more just if you're going to come into somebody else's environment, being able to speak their language goes a long way. Because I would do these presentations where I'd be in Beijing before 25 guys, very large mutual fund. I present for an hour with a translator, the whole 9 yards, and no one utters a peep of English. And then at the very end, the main guy, starts talking, and it's questions of perfect English right out. And they all laugh because they all make it seem like, oh yeah, we wanted you to think that we don't speak English. So I'm like, thanks guys, appreciate it.
That's fun.
But listen, let me jump right in. So, in your world, one of the things that I think is interesting, and maybe you should tell the audience, I mean, there's going to be an introduction to our presentation, and maybe you could tell the audience what you do in this trading space right now and the kind of the niche that you are carving out with you and your associates.
Sure. I'll just give a sort of a top level. So TCG Capital is a family office. Originally, the family we're starting with my grandfather, who was in the chemicals business in 1918 in Shanghai, moved that business to Hong Kong in 1950. And my father came back into the business in the 60s, got us into electronics, got us back into China in the 70s. And over time, they sold down the manufacturing assets and quite wisely joined some others to put some money into residential real estate in South China, Hong Kong, South China, and did quite well by that. And now I came back after education in the United States in 2001, and we set up the family office, TCG Capital, in 2003. With a mandate just to look at uncorrelated returns. That ended up driving us to evaluate the marketplace. We made lots of wrong turns. We thought private equity and venture capital might have been a pathway. That didn't work out. So we ended up focusing actually around medium-term trend following because of its wide availability and sort of seemingly uncorrelated to the broader asset classes properties, which was fitting with our mandate. So we started putting money into that in 2006, and I think we got lucky. 2006, 2007, and 2008 turned out to be very good years for the medium-term trend following. 2009 was not so good as the market normalized. So we started looking at short-term trading strategies and also relative value, commodities, volatility, and equities as a way to try and diversify away from just the medium-term trend following. That typically meant going with emerging or smaller managers. And so we weren't very comfortable with the fund structure. So we pulled most of the money out of funds and placed it into managed accounts that we could more tightly monitor and control. And then over time, that ended up being a somewhat unusual combination for a family office to go into quite eclectic strategies by emerging managers and also on a managed account basis only. So last year, I think we started getting approached by market makers and prop traders because it seemed like a reasonable next step evolution of our process to be able to support their trading. They liked it that it was family money, so stickier, more loyal, and at the same time, it was managed accounts. It had to be that, and you had to have certain regulatory presence in order to enable that for a market maker. So we were quite comfortable structuring ourselves accordingly. So it's been a recent evolution, but we then started. We've been most active with U.S. equities to support trading groups, prop traders in a regulatory compliant manner. But we're also looking at various options and FX market making opportunities. So we're slowly onboarding these throughout this year, and well into next, we anticipate still onboarding them. So yeah, that's kind of where we are now. As a brief aside, the other side of the business that TCG is involved with is trade and commodities finance. So those were, over a process of multiple years, those two areas turned out to be the only two that we found could be uncorrelated to the broader markets and deliver their returns regardless, if not benefit from volatility in the markets. And both of them turn out to be major beneficiaries of large banks shedding their prop trading and, to some degree, niche lending operations.
Well, let me. I think the idea, at least in my experiences in Asia so far, and I mentioned the Chinese cities that I traveled to and spoke with various funds, but this spring I was also in KL, in Singapore, Hong Kong, Tokyo, and speaking to a lot of different types of funds, Singapore Sovereign Wealth Fund, the Malaysian Sovereign Wealth Fund. And what I found was I found mostly value-based, the typical strategies, absolutely nothing about what you just described. I mean, not even close. I mean, we're talking buy and hold indexing, and these were some of the biggest names in all of Asia, whether it's hedge, mutual funds, sovereign wealth funds. The only operation that I saw that remotely had, and I guess it's not going to be surprising to you, would be Richard Chandler's office out of Singapore. Everybody else was completely locked in to just the typical way that you would see in America. Everyone's locked in. So my question to you is, how did you, you said you spent a lot of time in the States and you've got a sophisticated standpoint on it, but there's not a lot of people that I was bumping into that maybe have a mandate of looking at uncorrelated returns. How did you work your way? And as your background, you might want to mention your background. You didn't come from the banking industry. You didn't come from the brokerage industry. So how did you develop this idea of we want the uncorrelated returns? Where did that start?
Sure. I mean, my education was mostly in the sciences, molecular biology, and I think the process started with just the turmoil that we witnessed in Asia from 97, 2000, so on. Every few years, whenever something happened elsewhere in the world or in the region, all of our traditional holdings got flushed down the toilet, and we were a little tired of that, and which is why we tried to go for this mandate of looking only for the uncorrelated returns. Of course, at the same time, relative to the large players that you mentioned, we have the benefit of not being very large, a curse and a blessing, I guess. And when you're not that large, you're not forced to go down particular paths due to capacity. So the way we view capacity is that we love the small capacity strategies, which are typical for market making, prop trading operations. And the problem with them generally is that for most of the larger operations, they couldn't even submit an idea to the committee, investment committee, if it was under, I don't know, 10, 15, $20 million opportunities. But most of the most attractive ones are probably in the sub 5. So it's just how willing are you to put in a ton of work for a tiny investment, which could have reasonably good returns relative to that size. But it's, in terms of deploying capital, people's view is just skewed by $1 means $1, whereas the way we see it is we'd rather work really hard for a $1 investment and leave $4 in reserve and achieve the same level of return as what a 5 times sized regular investment into an asset class that would most likely get flushed down the toilet at any turmoil, which is standard. So I think that's what it was, just an iterative process over now 10 years since we started looking at the markets with that initial mandate, which was that wasn't my idea. It was really the family's idea to address the issues of 97 and 2000 that faced us.
So it's interesting. You weren't, I'm sure you've read it, but instead of writing the book, The Black Swan, you were living it and saying, hey, hold on, enough.
We weren't that intellectual. I think it was more just a process of, you just get hit enough times. You just want to change something, and not changing it, or at least experiment. I think that was the big value that being in a family office gave the opportunity to me was to experiment. So in the beginning, we made tons of small investments, and we didn't mind paying up fees when we were small investors because we were learning. It was the process of just, you don't know something until you put some money, however small, to work. And then when it doesn't work, you really feel it. You feel pain. And that process of pain is how you learn. At least that was how it was for us. You can try to read up as much as you could, but until you're, some guy was saying his favorite philosopher is Mike Tyson, in that everybody has a plan until they get hit.
There you go. Seriously. I guess I should appreciate the fact that you describe your family background and the diversity and how you moved from different business to different business and different style. Where would you trace the attitude back? Would it be your grandfather, your great grandfather? Where would you trace this entrepreneurial attitude? Because in many ways, the way you describe your family, in many ways, it's like a trend following trader looking at the beginning of the year. You don't know where your money's going to come from. So it seems like your family over many generations just said, what's the best opportunity, and let's be nimble and let's be flexible. Or am I generalizing too much?
No, that would be an accurate reflection of the result in hindsight. But I would say the ultimate source of that was, there's no doubt we were lucky. We were lucky in many respects. We caught various waves, and sometimes without knowing them, that there was a tailwind at certain points that helped us. So that's luck, and there's no questioning of that. But I'd say these opportunities came to us mostly because it's sort of what we initially spoke of doing business in China. And it applies, I think, all around the world, which is be nice, be friendly, talk to lots of people, learn something, be open to ideas. And there was very little beyond that. And then sort of when you get down to really trying to do it right, then attention to details, costs. So, I might have mentioned before, but we don't really believe in the alpha. We just believe in cost and risk. And we believe if we get those two right, and then we try to get some relatively less correlated strategies working in our favor, the returns will take care of themselves. But the pursuit of an alpha driver, or that someone can pick stocks, or that someone can do certain things better, generally we're very skeptical. And we're even more skeptical of strategies that have no real purpose in the market, in the sense that it's sort of trading for trading's sake. So loosely, their only purpose is to provide that sort of 10-to-1 ratio of liquidity so that hedgers can properly hedge at a reasonable price in a marketplace. So we like to see a reason for why a strategy exists so that we know potentially it could be more longer term and more durable rather than a flash in the pan. It was a sort of a overfitted to the present market condition, and then that changes. Once markets, as they always do, change, then that strategy falls apart.
You know, I have debates with people often, and I'll end up, of course, in many times talking about trend following trading. But I think one of the nice things that I found about it is the data. So as you just make the case about strategies that maybe don't hold up or whatnot, I think if people are trying to make the case for a strategy, show some data over a long period of time, even if it hasn't been traded because you just developed it recently, you've only been trading for 5 years, show how it would have performed over time, give some feeling. And I find there's just a ton of people out there that still don't get the idea that people like you just want to see some data. Just give me some data. Don't give me the stories all day long.
That's I would say that is true, certainly for trend following. I guess you could extrapolate that to you're looking for data points. So if it was a shorter term strategy, while there are weaknesses in doing this, by looking at shorter term strategies, you have a richer data set without requiring such a long time frame. The problem, of course, is that could be specific to an environment. So then while you have a rich data set, it was all coming from one market environment. And once that changes, there's certainly some risks associated. But at the same time, given the short-term nature of that type of trading strategy, markets can fluctuate, but they typically do that over multiple time frames, multiple day frames, and the intraday shocks, while very damaging, are they can be loosely managed or taken. It's also a question of, are you being compensated enough for the risks inherent to your time frame? I would say at the same time, we've gone into strategies where it wasn't so much the story, but it also wasn't so much the data. It was sort of our loose understanding of market microstructure, and it was something needed, and it had never been done before, but it made a lot of sense in supplying liquidity, quoting a two-way price into markets that really did not have that previously, but there were precedents that it worked in other markets. We like data, but at the same time, there's certain cases where you have to make a leap of hopefully not just faith, but a leap of understanding of translating that if something worked in one market, it's likely that it will be needed in another similar market.
I've caught a lot of different things that you've talked about in your career so far. And one of the things, and you say it like, hey, this is just par for the course and it's in your blood. But when you say, hey, I categorically reject the Sharpe ratio, a lot of the investing world doesn't categorically reject the Sharpe ratio. So, do you find it interesting that you can believe that in your core so easily, and you look at many peers out there that maybe they get exactly what you get, but just because of circumstances or frankly the job they're in, or as you said, maybe the assets can't be moved, so they've just got to be stuck in this one strategy where they got to keep talking the Sharpe ratio, even though it's not a great measurement. Do you just find it odd that in this day and age, we still don't have most of the investing world saying exactly what you say about the Sharpe ratio?
I don't. I think I'm a little out of touch maybe with what the broader world is saying, as I've been sort of locked in my room looking at certain things. But I mean, it was just a process of pain. We tried to use the Sharpe ratio, and thankfully we got hit earlier rather than later. And then after a while, we kind of threw out that number and we just stopped looking at it. We didn't think necessarily intellectually, oh, we're rejecting it. We're just kind of like, this is one number and it captures certain things, but there's more. There's always more. Are we are we perfecting our understanding of sort of, can we get loose rules of thumb that help us filter? And so it was just a mad grab for tools that can help us filter out strategies that sort of didn't work out so well. And that's how we just sort of came upon other measures. And the most key measure is really pain, sort of a pain to gain and so on, that type of ratio. But at the same time, I would say sometimes we face a problem that once we get into the sort of the short-term strategies, market making short-term, you don't have enough data points to get a pain gauge, because you would have to, becomes these, generally these strategies are consistently profitable, but there's always that risk, and that risk, it doesn't happen quite as much so that you can characterize what the pain would be. It could be a 1 in 10 year thing, like a true 1 in 10 year, not the everything is supposed to be 1 in 100 years, yet it happens every 4 years. But really a 1 in 10 year related to a landmark change in market. So that requires throwing away numbers and, funnily enough, going back to sort of a fundamental understanding of the marketplace. And so, I would have previously said, we can use numbers and we can reject sort of fundamental analysis of what's going on in the market. And now we've sort of come back full circle, embarrassingly come back full circle, and said, actually, there's some times when there's just not enough data points and you have to take each case as is and maintain your understanding of the marketplace and how landmark shifts, like, the yen exploding or exploding down or up as you see it, rates potentially moving, all these things, Fed quantitative easing, all these things that were really sort of previous data points found did not really capture, unless maybe you went back to the 60s, going back to an inflationary period. Then you could maybe start modeling. But then again, back then, the data wasn't as rich. You probably couldn't get tick data. You couldn't get very detailed data again. So no free lunch, I'm afraid,
Yeah.
in conclusion.
I'm going to jump around on you some too, because I got a bunch of different ideas I want to talk with you about. Chinese investors, I believe I'm attributing this correctly to you, but you seem to point out that Chinese investors today, and I'm generalizing here when I say the phrase Chinese investors, that can include a lot of different types of experiences and understandings and successes and failures, but in general, are more driven by returns, and they're agnostic to investment strategies, whereas in the more mature institutional climates, you might have people that have all these biases against certain styles of trading, and they're really not even at the point where they want to even look at the returns or the benefits anymore. They're literally just biased against certain strategies. And I find that refreshing, I guess, in some ways. Am I correctly attributing to you a little bit on that thought?
Yeah, I'd agree with that. And that from what we've seen, again, mainly, I guess, from quantitative driven strategies, but also look at the explosion in wealth management products, that basically any strategy you're doing, if you're curb lending to real estate, as long as you could just phrase it as a fixed yield, someone seems to be willing to buy it without any understanding of what you're going to do, without any notion if you have collateral backing it. So what we've seen, that the nature of the Chinese investors being agnostic to trading strategies, quantitative, whatever it is, it ended up being, it's refreshing in that it's not biased, but it's also somewhat a little scary in that they just kind of treat everything as a yield play, that they translate everything into a yield play. So for a strategy that makes money, if the minute it loses money, they either pull out, or they structure the whole investment so that it's really more like a lending exercise where someone has a strategy. These investors are not equity investors. They're really more like debt investors going into say, even a trend following strategy, which is a little scary because trend following strategies, all strategies do have these drawdowns. And if the manager accepted that kind of arrangement, unless they were absolutely certain that they wouldn't have drawdowns to a certain degree, they're really just loading up leverage on their strategy. So it's a little scary. I've yet to see that investors were comfortable with coming in as investors rather than as sort of providers of debt capital to a strategy.
You know, what I should clarify is I tell you this little story that happened to me, but you know, obviously in America we've had our situation of schemes, Bernard Madoff, bad trading strategies, LTCM. So there's no shortage of funny stuff that's happened in America. I was speaking it was in the offices of one of China's top 10 largest mutual funds. So anyone can go crank the numbers. That's significant assets under management when you're the top 10 in China. And I was giving a trend following presentation and we were discussing drawdown. And they looked at me and he said, well, we can't accept those kinds of drawdowns. And I said, okay, but drawdowns are inherent in every strategy. You've got to accept some kind of a drawdown. He goes, oh, no, we don't accept any drawdown. So, okay. I said, well, hold on. I said, what do you mean? He goes, if we have a 10% drawdown, that's it. I said, what do you mean that's it? He said, if we have a 10% drawdown, we return the money to the client. And I said, okay, well, when do you start the strategy up again? How does that happen? He goes, oh no, once we go down 10%, we lose that client, we close that fund, and we don't ever get that client back again. Then we just start a new fund. It was all said with a straight face.
Yeah. Well, I mean, I can sympathize though in that many investors, ourselves included, you know, we're always too optimistic. We always, all the warnings in the world of track record is historical, it doesn't forecast the future, blah, blah, all that kind of stuff. We always take those in and it kind of just washes over us and we'll still go into it. It is kind of harsh to have 10% and then shut down. But then again, you could say that some of the most successful investors have had a similar policy themselves, but more sort of when they're running a mix of strategies and on an internal basis where, 10% is that line. Double-digit losses is where we cut off a trader, cut off everything. Maybe not forever, but the tight risk management discipline is good, but only if you're equipped to be handling it as such. When it's sort of an investor coming in and then pulling out, that might be a little detrimental. If anything, I'd be I wish I had the time to try a strategy of going into managers and strategies only after they've had a 10 to 20% drawdown, because all the other times we ended up we've top ticked the investment so many times that we thought about maybe we just do the opposite. Whenever we want to invest, we should just hold ourselves back and then just wait until a drawdown before going in. You know,
I should say though, as I give that one story, I don't want to make that seem like that was the entire picture that I came across. In the various cities, countries, funds that I was speaking to, I found the investors in China, the mutual funds in China, were most receptive to the idea of a trend style trading. Were most receptive to the idea of being aware of black swans, whereas almost every fund that I sat down with in Malaysia and Singapore, Tokyo, literally this stuff wasn't on their radar list. They didn't want, or their radar screen. They didn't want to talk about it. And they frankly just weren't interested. But I found in China a much more, I guess in many ways, the conversation talked about your background, much more nimble, like, hey, look, this guy's here. He's telling us some information. Maybe we're not familiar with it. Maybe we're not familiar with it. We've heard some about it, but I found a receptiveness that I didn't necessarily see in other places.
Yeah, I think there's certainly, one should never underestimate the talent that is there and how quickly, in many cases, I would say that this nimbleness comes from not being shackled by too much sort of, let's say, traditional views on finance and sort of the entrepreneurial culture coming back into finance in the good way. But of course, there's a bad side to that, in that many have never witnessed how painful a downturn can be. People in Hong Kong always can point to 97, whereas in China, while there have been some bad downturns, they were cushioned in many cases. It was either too early in the cycle, so these downturns were brief and then it continued marching upwards, or they were cushioned by the state in '08, if not cushioned, completely pushed back up to new levels by the largesse of the state. But now I think we're walking into a very dangerous time where the bullets are more or less spent. And there's so many different imbalances that are coming to a head that it will be a real test for the Chinese investors, if the past few years have not already been, and I'm referring mainly to equity investors, who've seen a market that sort of steadily marched down, blipped up, and then marched down.
Well, it's funny. I see the competitiveness between China and America, and it seems like on both sides right now, both groups of investors feel like the state, so to speak, is there to make sure everything gets straightened out and taken care, and let the onward march of equities move straight up. And we just know historically that there's something comes out of the side or unexpected, and it just changes that whole narrative right when you least expect it.
Yeah, I would say. I mean, and the funny thing is, we're given that you wrote so many books in the area. It's been just as rough for all the trend followers out there, and almost all of them would attribute it to intervention, which was not seen before, where trends typically down were cut off before their fruition, and it's been So I think that it would be an interesting measure of when trends come back, if they do it all in the next couple of years.
Well, it is an interesting topic because there's no doubt. Like, I mean, I know you've mentioned, or at least I've seen you mention in some of your writings, that you like to do well in bad times. And so when U.S. equities are at all-time highs, by most definitions, that's hard to say that those are, quote, bad times.
Right, you're kicking yourself during all the time when it's marching up, and there's one day when it comes down, and you're kind of cheering. Unfortunately, in our case, what happens is we're cheering on one portfolio, and then we're kind of crying on the other because we are not fully invested into just that piece, and so there are traditional assets that we still hold on to, and those just kind of take the pain. Well,
I think as we wind our conversation down, I think the thing that I want people to take away from is that I like the entrepreneurial aspects that I see in Asia, and now I'm generalizing, but I see less and less of it in America. It's definitely there. Look, if you go to Silicon Valley, in San Francisco, it's roaring, okay? But there's just less and less. And maybe it's a function of just everything's new, and there's a whole growth phase, but still, there just seems to be this entrepreneurial spirit in Asia that I miss in America. And I hear it in your family story and how you're approaching trading, and I think that word entrepreneur is a word that, I don't know, I just think it's a great word for people to really let sink into their soul, so to speak.
I think, that's what was interesting. I just came back from a trip through the U.S. was I was, every time I go, I'm always amazed by the talent in terms of trading strategies, small capacity constrained trading strategies, often coming out of Chicago. And the talent there is just incredible because it's become really a center for prop trading, market making, because of the futures exchanges and all that. And yet sort of many of these traders couldn't find a home, because sort of to support them, you had to have both an entrepreneurial spirit, but also a keen appreciation for costs and increasingly regulation and the compliance requirements. So I think in our entrepreneurial vein, we do want to be giving these entrepreneurs a home to try new strategies in a regulatory compliant and adequately supported, but not excessively cost insensitive manner. So, hopefully we can do some good things for people there. But I think there's talent, just as much talent in the U.S. as there is in China. It's just maybe to tackle different aspects of the financial markets, given exposure. The U.S. being exposed to a lot, and China being sort of much more used to trading in its own home turf. And there they will pick apart strategies and markets and figure out ways. And then some of that talent actually does get deployed overseas to, and then when it does, it's quite amazing what can be done. But it all needs a home. So hopefully we can provide that.
I was going to say, it sounds like you're trying to make the case to get some of these Chicago guys to come set up shop in Hong Kong.
That's funny that some of them have, but in general, I would say that the two centers of that type of market making are probably Amsterdam and Chicago. And I would say the Dutch have made far more inroads globally than the Chicago guys have. I would say the talent is very similar. I think it's more the internationalization and the pressure to do so, Chicago being so big and having so many aggregations of exchanges right there, sort of never were compelled to leave. Whereas the Dutch, I think, the European Options Exchange bred a whole generation of market makers, but its limited size meant they had to expand throughout Europe and then eventually throughout Asia. So, it is time that the Chicago shops were given an international exposure. Hopefully we can support them in that, but I think they will come to that conclusion regardless, just by market pressure.
Well, it's interesting. The Dutch for sure, going back many centuries, have been the traveling entrepreneurs. So very wise to that. And in America, we have this big country locked in by two oceans and haven't had to go anywhere. And I think that's changing pretty quick.
I would agree completely.
Yeah. Hey, Eric, what's the best place if people want to find out more about you? They want to go check out your business, maybe even reach out if they have a question or two. What's the best place for them to reach you?
Never really thought about that. But
if you don't want them to reach you,
we just never thought about that. We were just chiseling away in our little workshop, and we never thought that anyone would want to reach out. But we'd be happy to speak to anyone who does. I would say maybe over email would be easiest. Our company email is info at tcg-capital.com. So I'd be happy to try and answer any questions that might come our way. Please, I apologize ahead for any delays in getting back. But we'd be happy to answer any questions people might have.
Yeah, I just think you're in the midst of I guess a bridge. I would say, so to speak, from my perspective, and I think that's a fun place to be. You know, I think sometimes just on a really basic human level, we all get caught up in maybe some task or job, so to speak, that's just paying the bills. But I think when things get very international and you're connecting countries and connecting, in your case, traders, that's exciting. It's exciting to just be looking at the world in a very wide way. I always enjoy that, and I always enjoy those conversations and learning from people that are coming at it from different walks of life. So I appreciate your time today.
Thank you very much. I appreciate talking with me.
And hopefully we can we'll catch up again soon. I'll have to make it up to Hong Kong since I'm in Saigon. I'll have to make it up to Hong Kong. We'll have to grab lunch.
Absolutely, and I hope to be down there as well and pay you a visit.
Sounds like a plan. We'll talk soon, Eric.
Great.
Take care.
Talk soon.
Bye-bye.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.